Imagine this. You just got your first job, your first steady paycheck is finally coming in, and after paying your rent, bills, and a few takeout meals, you realize you have around $200 left over every month. Now, you've heard 1,000 times that you should invest early because the sooner you start, the more your money grows. But the moment you start looking up where to put that money, you get lost in a jungle of terms. Stocks, ETFs, mutual funds, each one sounding like some kind of secret club you were never invited to. Should you just pick a famous company like Apple or Tesla and buy one share? Should you listen to your bank advisor telling you about a mutual fund with a fancy name? Or should you go for those new age ETFs you see everyone talking about online? Today, we're going to break this down in the simplest way possible. So by the end of this video, you'll know exactly what each of these is, how they work, and which one might make the most sense for you as a beginner in 2025. First, let's start with the basics. Stocks. A stock represents a share of ownership in a single company. Think of your favorite coffee shop, let's say Starbucks. If Starbucks has 100 million shares and you buy one share, you now own one little slice of Starbucks. It doesn't mean you can walk in and get free coffee, but it does mean you benefit if the company does well. If Starbucks launches a new drink that goes viral and their profits go up, the value of your slice, your share, usually goes up too. But here's the flip side. If that company has a scandal or sales crash, your slice can lose value overnight. One bad earnings report, one CEO mistake, or even a market rumor can make your stock price fall 20% in a week. Stocks are powerful because they can grow a lot. If you picked Amazon in 2010 and held it till 2020, your money would have multiplied many times. But they're also risky, because you're betting on one horse in a very unpredictable race. Now, let's talk about mutual funds. Imagine instead of betting on just one horse, you go to a race where there are 100 horses and you ask a professional trainer to build you a team. He chooses a mix of strong horses, slow but steady ones, and some new ones with potential. That team is your mutual fund. You don't pick the horses, the manager does. You just put your money in and let them handle the buying and selling. Mutual funds are basically a collection of stocks and sometimes bonds managed by professionals. They're bought or sold only once a day after the market closes, so you don't see the price jumping around minute by minute like you do with stocks. That sounds great for beginners, right? Someone else doing the hard work. But here's the catch. They charge fees, sometimes 1%, sometimes even 2% a year. That may sound small, but over 30 years, a 1% fee on a $200 a month investment growing at 8% can cost you almost $100,000 in lost gains. Why? Because that fee eats into your growth every single year. Finally, let's break down ETFs, exchange-traded funds. ETFs are a bit like mutual funds' younger, more flexible cousin. They also contain a basket of stocks or bonds, but they trade on the stock market just like individual stocks. That means you can buy and sell them anytime the market is open. Most ETFs are passive, meaning they just track an index like the S&P 500, which is the 500 largest companies in the US. So instead of buying a single company with one ETF, you instantly own small pieces of Apple, Microsoft, Amazon, Google, Coca-Cola, and hundreds more. And here's the good part. ETFs usually have very low fees, sometimes as low as 0.03%, which is basically free compared to mutual funds. They're also more tax efficient because of how they're structured. So now that you understand what each one is, let's compare them. Imagine three friends, Sarah, Mike, and Jason. Sarah decides to put her $200 a month into a single stock. She chooses a popular tech company because everyone on social media is hyping it. Mike invests the same amount in a mutual fund his bank recommended with a 1% management fee. Jason chooses a broad S&P 500 ETF with a fee of 0.05%. Fast forward 10 years. Sarah's stock skyrockets for 2 years, then crashes, and she ends up with about $18,000. Mike's mutual fund grows at a steady pace, but loses a chunk of returns to fees. He ends up with around $28,000. Jason's ETF, tracking the whole market, ends up with about $36,000. He didn't pick the winner, but he didn't pick the loser either. He owned the whole game. So, which one is best for beginners in 2025? Here's the honest answer. For most beginners, ETFs, especially low-cost, broad-market ETFs, are the sweet spot. They give you instant diversification, very low fees, and you can start with even $50 or $100 a month. Mutual funds can also work if they are low-cost index funds, like those offered by Vanguard or Fidelity, but be careful with the ones that have high fees or sales commissions. Stocks are not bad, but they require research, patience, and the ability to stomach ups and downs. If you're just starting, putting all your money into one or two stocks is more like gambling than investing. Before we close, let me share a quick story. My friend Alex used to spend about $6 every morning at Starbucks. Coffee and a muffin. That's roughly $180 a month. One day, he decided to cut that in half, make coffee at home 3 days a week, and invest the $90 he saved into an ETF. 5 years later, without even noticing much change in his daily life, that little change added up to over $7,000. It's not about being rich overnight, it's about small, consistent habits. So to recap, stocks are exciting but risky, mutual funds are convenient but often expensive, and ETFs are usually the best starting point for beginners in 2025. They're simple, cheap, and flexible. Start small, be consistent, and give your money time to work. That's the real secret. If this video helped you understand the difference between stocks, ETFs, and mutual funds, hit the like button, subscribe for more simple investing guides, and share it with a friend who's just starting their money journey.